we go. Investment flashcards. Unsystematic risk. Known as diversifiable risk, may also be referred to in some reference books as non-systematic risk. Business risk refers to the nature of the firm's operation, possibility of loss due to new technology. Financial risk refers to how the firm finances its assets, possibility of loss due to heavy debt financing. Systematic risk, also known as non-diversifiable risk. This part of risk is inescapable because no matter how well an investor diversifies the risk of the overall market cannot be avoided. Types of systematic risk: prime, purchasing power risk, reinvestment rate risk, interest rate risk, market risk, and exchange rate risk. Purchasing power risk is loss of purchasing power through inflation. Reinvestment rate risk, risk that proceeds available for reinvestment must be reinvested at a lower interest rate than the instrument that generated the proceeds. Interest rate risk, that a change in interest rates will cause the market value of the fixed income security to fall. Market risk of the overall market. Exchange rate risk associated with exchanges in the value of currency. That was types of systematic risk. FDIC insured amounts per bank per type account. Individual, $250K. Joint, $250K. Trust, $250K per beneficiary. IRA, KEO, $250K. The yield ladder. This is going to be hard to do on a flashcard, but here is the yield ladder. And you've got YMCA, discounted bonds, yields higher than coupon, yield to call, yield to maturity, current yield, nominal yield, annual coupon rate, current yield, yield to maturity, maturity yield to call, yield lower than coupon premium bonds. So yield to call, yield to maturity, current yield, nominal yield, which is the annual coupon rate, YMCA. Double E bonds, non-marketable, non-transferable, cannot be used for collateral, sold at face value, interest rate based on 10-year Treasury note yields, fixed interest rate that is in effect at the time of purchase, subject to federal taxation when redeemed, unless used as education bonds, not subject to state or local taxes. I bonds, non-marketable, non-transferable, cannot be used for collateral, sold at face value. Interest rate is composed of two parts: a fixed base rate, remains the same for the life of the bond, and an inflation adjustment, adjusted every 6 months. Subject to federal taxation when redeemed, unless used in education bonds. Not subject to state or local taxes. Types of municipal securities. General obligation bonds, backed by the full faith and credit of the power of the issuer. Go bonds are generally considered the safest type of municipal credit. Revenue bonds, backed by a specific source of revenue to which the full faith and credit of the issuer is not pledged, because revenue bonds are backed by a single source of funds, like toll roads, hospitals, or nuclear power plants. They have a greater credit risk than go bonds, such as they trade at higher yields. Insurer municipal bonds. The insurers pay timely interest and principal when the insurer is in default. Municipal bond insurers are AMBAC, American Municipal Bond Assurance Corp., and MBIA, Municipal Bond Insurance Association Corp. Indenture agreement covers. Form of bond. Amount of issue. Property pledged. protective covenant, including any provision for a sinking fund, working capital and current ratio, redemption rights, call, put, or conversion provisions. That's indenture agreement covers. Corporate and municipal bonds, DRIP, default risk, reinvestment rate risk, interest rate risk, and purchasing power risk. DRIP, acronym DRIP. Default risk, a creditor may seize the collateral and sell it to recoup the principal. Reinvestment rate risk, as payments are received from an investment, interest rates fall. When the funds are reinvested, the investor receives a lower yield. Interest rate risk, rising interest rates may cause bonds prices to fall. Purchasing power risk, inflation may lower the value of bond interest, payments, and principal repayment, thereby forcing prices to fall. That was corporate and municipal bonds, DRIP. Government bonds, RIP, there's no default or credit risk. So it's the same as DRIP, but no D, there's no default risk. So you still have reinvestment rate risk, interest rate risk, and purchasing power risk. Capitalization market of company. Large, market value exceeds 10 billion. Mid, market value is between 2 to 10 billion. Small, market value is less than 2 billion. Micro, market is less than 300 million. That's capitalization market of company. American Depository Receipt, ADR. Prices of ADRs quoted in US dollars. Dividends paid in US dollars. Dividends declared in foreign currency. Attain diversification and risk reduction due to lower correlation of foreign securities with US securities. That's a ADR, a American Depository Receipt. Now we're on real estate, land improved, NOI. Improved land is normally income producing. Income properties include residential rental, commercial and industrial properties. The intrinsic value of real estate property can be computed using a net operating income computation. NOI computation is gross rental receipts plus non-rental income divided by potential gross income, PGI, minus vacancy and collection losses minus operating expenses equals the net operating income. Options, general definitions. Intrinsic value is the minimum price the option will command as an option. It is the difference between the market price and the exercise price of the stock. Exercise price, or the strike price, is the price at which the stock can be purchased or sold on exercise of the option. Premium is the market price of an option. As the option approaches its expiration date, the market price of the option, the premium, approaches its intrinsic value. Time premium is the amount the market price of an option exceeds its intrinsic value. Intrinsic value plus time premium equals the premium. IV plus TV equals premium. Call options minus taxability. At the time of purchase, non-deductible capital expenditure. To the writer due to lapse, premium paid is short-term gain. To the writer due to exercise, premium paid is added to the sale price. Can be long-term gain if the underlying security was held more than 12 months. Otherwise, it is short-term gain. Covered call. To the holder, it is to the holder. If the option is not exercised, then the option is considered sold. It expires and it is a short-term loss. The option period is 9 months or less. Hedging strategies, straddles and combinations, collar, protective, put. Straddle, buying a put and buying a call. The buyer does not own the stock. Caller sells a call out of the money at one strike price and buys a put at a lower strike price. The investor owns the stock. Protective put, buying a stock or owning it already, and a put for the stock serving as insurance against the decline in the underlying stock. Good answer for the exam. Protective put. So I'll read that again. A protective put is buying a stock or owning it already, and a put for the stock serving as insurance against the decline in the underlying stock. Hedging strategies. Warrants versus call options. Warrants are issued by corporations, whereas calls are created by individuals. Warrants typically have maturities of several years. Warrant terms are not standardized. Call options are standardized. Warrants and call options. Futures contracts. Long commodity position. If a farmer is long a commodity, for example, corn, he needs a short hedge and will sell a futures contract. Short commodity position. If Kellogg's is short a commodity, for example, corn, Kellogg's needs a long hedge and will buy a futures contract. Arbitrage pricing theory, APT keys. Unexpected inflation, unexpected changes in industrial production, unanticipated shifts in risk premium, unanticipated changes in structure of yields. That's the arbitrage pricing theory. Regulation D, accredited versus non-accredited investor. Accredited, unlimited, net worth of $1 million or individual with an income of $200,000, couple with a joint income of $300,000. Non-accredited, sold to maximum of 35 investors, must use a purchaser representative if not sophisticated. Coefficient of determination of R squared. The square of the correlation coefficient, measuring the proportion of the variation in one variable explained by the movement of the other variable. How R squared is used on the exam. It describes the percentage of a fund's movement that are explained by the movements in the S&P 500 index. Index funds, diversified funds, funds based on the S&P 500 will have R squared of very close to 100%, while sector funds, not diversified, will have very low R squared, typically 5 to 25%. Risk level quantification, standard deviation versus beta. Standard deviation measures variability of returns used in non-diversified portfolios and is a measure of total risk. Beta, an index of volatility used in diversified portfolio and is a measure of systematic risk. Geometric return versus internal rate of return. Geometric return, or time-weighted return, evaluates the performance of the portfolio manager. IRR, or dollar-rated return, compares absolute dollar amounts. Real versus nominal rate of return. Real, the inflation-adjusted interest rate. Nominal, actual returns not adjusted for inflation. The real rate is defined as the nominal rate of the return adjusted for inflation. Holding period return. The total return, income plus price appreciation and dividends less margin interest over the entire period divided by the out-of-pocket cost of the investment. So total return over the entire period divided by the out-of-pocket cost of the investment. Taxable equivalent yield, TEY. To make the returns on municipal bonds comparable to those of taxable bonds, the TEY can be calculated. TEY equals tax-exempt yield over 1 minus the marginal tax rate. Or you can do tax-exempt yield equals TEY times 1 minus the marginal tax rate. Duration, principles to remember. Years to maturity. Remember, duration and maturity are positively related. Annual coupon. Remember, duration is inversely related to a coupon rate. Yield to maturity. The current yield on comparative bonds duration is inversely related. Remember, coupon and yield are interest rates, inversely related. Coupon bonds, zero coupon bonds. Duration equal to the maturities. No coupon interest yet produces phantom income. No reinvestment rate risk. Sold at deep discounts to par. Fluctuate more than coupon bonds with same maturities. That's a zero coupon bond. Using duration to manage bond portfolios. If interest rates are expected to rise, shorten duration. Interest rates up, shorten duration. UPS, up for up and S for shorten. Buy high coupon bonds with short maturities. If interest rates are expected to fall, lengthen the duration. Buy low coupon bonds with long maturities. Interest rates fall, lengthen the duration. Fall for fall and len for lengthen. So ups and fallen. Conclusion to fluctuations in bond prices. The smaller the coupon, the greater the relative price of fluctuation. The longer the return, the longer the term to maturity, the greater the relative price fluctuation. The lower the market interest rate, the greater the relative price fluctuation. Convexity. The degree which duration changes as yield to maturity changes. Largest for low coupon bonds, long maturity bonds, and low yield to maturity bonds. Allows investors to improve the duration approximation for bond price changes. Return on equity, ROE. ROE equals earnings per share over the common equity. Earnings per share, earnings available for common. Common equity, net worth or book value. So you do ROE equals EPS over common equity. Dividend payout ratio. Dividend payout ratio equals common dividends paid over earnings per share. 3 types of efficient market hypothesis, EMH. Strong form asserts that stock prices fully reflect all information, public and private. Not even access to inside information can be expected to result in superior investment performance over time. Neither fundamental analysis nor technical analysis can produce superior results over time on a risk-adjusted basis. Semi-strong form asserts that all publicly known information is reflected in stock prices. Neither technical analysis nor fundamental analysis can produce superior results over time on a risk-adjusted basis. Only an investor with access to inside information may consistently achieve superior results, but such access is illegal. Weak form suggests historical price data is already reflected in the current stock prices and is of no value in predicting future price changes. Technical analysis will not produce superior results. Fundamental analysis may produce superior results. Types of indexes, benchmarks. Yeah, I don't need to go to that one. Tax basis of mutual fund. First in, first out. Methods treat shares acquired first as being sold first. Specific ID requires the seller to identify the shares of the fund that are sold, allowing the investor to create gain, neutralize gain, or create loss. Most flexible. Average cost method allows investor to divide the total cost of all shares held by the number of shares held. Tax basis of mutual fund. Now we're on risk-adjusted measures of performance. This is the Sharpe index. First key, look for low R squared. Less than 60, it is a non-diversified portfolio. Second key, look for the highest Sharpe number. Risk-adjusted measures of performance. This is the Jensen or Trainer number. This is also alpha. First key, look for a high R squared, 60 plus, or diversified portfolio. Second key, look for the highest positive alpha. If no alpha given, then look for the highest trainer number. Margin call or maintenance call. The formula for calculating when an investor will receive a margin call is 1 minus the initial margin percentage over 1 minus the maintenance margin percentage times the purchase price of stock. Shortcut. You can do 2/3 of purchase price if minimum maintenance is 25%. If minimum maintenance is 30%, take 2/3 and choose the next highest number. Passive investment strategies. Buy and hold, EMH. Dollar cost averaging, index investing. Strategic asset allocation, revised every few years. Active investment strategies. Market timing, tactical asset allocation, technical analysis. Sources of federal tax law authority. Internal Revenue Code, primary source of all tax law. Treasury regulations, great authority but not law. Revenue rulings and revenue procedures, administrative interpretation may be cited. Congressional committee reports indicate the intent of Congress may not be cited. Private letter rulings apply for a specific taxpayer. Judicial sources, court decisions interpret. Sham transaction. A transaction that lacks a business purpose and economic substance will be ignored for tax purposes. Example, a sale of XYZ to ABC, but both XYZ and ABC are owned by the same person. Sold to self. Step transaction. Ignore the individual transactions and instead tax the ultimate transaction. Example, XYZ Corporation sells to an unrelated purchaser who subsequently resells the property to a wholly owned subsidiary of XYZ. So you tax the ultimate transaction. Substance over form. The substance of a transaction and not merely its form governs its tax consequences. The president of XYZ has the company loan him the money he needs. He never intends to repay the loan or take salary. Assignment of income. Income is taxed to the tree that grows the fruit, even though it may be assigned to another prior receipt. Example, Mr. Towns, XYZ, and S Corp., he directs that all income be paid to his son. Mr. T reports no income. So Mr. T has to pay that tax even though the fruit is assigned to his son. Dates for paying estimated taxes: April 15th, June 15th, September 15th, and January 15th. IRS penalties. Frivolous return, $5,000. Negligence. Penalty is 20% of the portion of underpayment attributed to negligence. Civil fraud, 70% of the portion of the tax underpayment. Failure to file, 5% of the tax due per month with a maximum of 25%. Failure to pay, penalty is 0.5% per month. The tax is unpaid with a minimum of 25% pay point. Federal withholding tax underpayment penalty. To avoid, pay the lesser of 90% of the current year's tax liability, or 100% of the prior year's tax liability, or 110% if the last year's adjusted gross income exceeded $150,000. Adjustments for adjusted gross income, AGI. The second step in the 1040 calculation is adjusted gross income. It is total income or gross income less adjustments to income. The main adjustments for or deductions to income are IRA contributions, self-employment tax, self-employment health insurance, 100%, KEO or SEP, alimony paid pre-2019 divorce. And those are all of the investment flashcards.